Hello ladies and gentlemen, my name is Greg Michalowski and today's date is June 27, 2014. I'm going to take a look at the dollar versus Canada as it makes new 6-month lows. What do we know about the dollar Canada from a technical perspective? What we know is that the market fell below the 200-day moving average. This is a simple moving average. This is the market fell below that level at the 107.78 level, and the market has not been back above that level since that break. We also fell below the trend line support connecting the most recent lows. The move below the 200-day moving average was the first close below the 200-day moving average going back to February of 2013, this little cluster right here. So there's a long time between the last time the market closed below the 200-day moving average. So the follow-through selling that we've seen over the last week and a half is not all that surprising. That is what should happen in a bearish type of market, in a move where the bias switches from bullish above the 200-day moving average to bearish below the 200-day moving average. However, having said that, we are approaching the next key support level. That is a 38.2% retracement at the 106.487 level. This is the 38.2% retracement of the move up from the 2012 low to the high that we saw in this year in March of 2014. That level should provide support, or profit-taking buyers should come in against that level, or new buyers against that level, because risk can be defined and risk can be limited against that technical support level. If it does break through there, there's really nothing much until we get to the low for the year. That low for the year came in at 105.87, and that occurred on the first trading day of the calendar year, and that would too be a target on the downside. But there should be some support here at the 48 level. We'll be watching that if the market continues in its downward bias. What would turn the market back to the upside? Well, holding the 48 level would be a step number one for the bulls or for buyers. If the market can hold that level and start a move to the upside, that would be a good sign that perhaps a bottom is in place, or perhaps a correction is in order. What would confirm that level would be a move back above this trend line here. This is the hourly chart here, and this trend line connects 1, 2, 3, 4 different points, and the market's held that level, including today, not just but a few hours ago, where the market came up to that technical resistance level at the high for the day. And the market found sellers against that level. Why? Because risk can be defined and risk can be limited against that level right there. So until the market were to get back above this trend line and prove that the buyers can overtake the sellers above this line and stay above that line, the bias remains to the downside for the dollar versus Canada. So there may be support down below at the 48 level. Traders can lean against that level and hope that the market stays above that level. But ultimately, if the market's going to go higher, we're going to need to get back above this trend line. If we get above this trend line, we have the 100-hour moving average, which currently comes in at the 107.19 level as a resistance level. We fell below it here, haven't been above it since that point as the market's trended. Above that level, we're going to have this top side parallel trend line, I guess, and also the 38.2% retracement of whatever the move is to the downside here at 107.52, and then the 200-hour moving average at 107.69. Those are the targets on the top side, only and only if the market's able to get back above this trend line. So the bias remains down in the dollar versus Canada. We'll see if the 48 level holds support or near the 48 level, and then we need to get above the trend line. My name is Greg Michalowski. This is a look at the dollar versus Canada.